and joining us with his outlook for the weeks and months ahead is Schneider Head of Market Analysis, Stephen Gallo. Stephen, great to see you.
Good morning.
Well, what's the major show in town right now?
I have to say, I mean, you're talking about the outperformance of the U.S. economy. I mean, that is one of the things that is furthest from our hypothesis for 2010, 2011. We don't see an outperformance of the U.S. economy. That is a stronger dollar on the back of capital inflows into the U.S., unexpected outperformance of U.S. GDP, higher levels of inflation. So I'm not exactly sure where that optimism comes from. I realize that we've had a couple of good data points from the U.S. in recent weeks. Non-farm payrolls for November was better than expected, but outperformance is a bit tricky in an environment where you don't have cheap credit growth anymore, where you have an over-leveraged consumer, over-leveraged households, and you have people repaying previous debts. So that's the first thing I want to say to that. In terms of what the markets are looking like at the moment, we're sort of coming to the end of the road here. Risk is being taken off the table aggressively last week. We saw a nice rally in the dollar index. The Dow Jones Industrial Average lower on the week. The level of shorts in the dollar fell to their short positions in the U.S. dollar fell to the lowest level in 10 months last week. So it's a clear risk-off mentality at the moment, and that's acted in support of the dollar.
Stephen, what about the euro? I mean, it surprised you how much it's fallen against the dollar in such a short time frame?
No, not really. I mean, you know, as far as growth prospects, you know, the Eurozone doesn't look a whole lot better. In aggregate, I would say the leverage in the Eurozone is probably lower than in the Anglo-Saxon economies, which does bode a little bit well. You know, it might be a positive thing medium to longer term. But in terms of the euro trade, I mean, most of the euro strength has been a result of the weaker dollar. Remember, it is at the moment the largest alternative to the U.S. dollar. I think in the next 5 to 10 years, we're going to see a much more balanced reserve currency space, so there's a more even weight across the spectrum of reserve currencies. But at the moment, it's the major alternative to the U.S. dollar. If you don't like the dollar, you like the euro.
Yeah, and what do you like about the yen?
I mean, it's a lousy-looking currency, to be honest with you, in terms of, actually, if you look at how the yen has performed so far this year, even though we've had all this talk about yen strength, it actually is lower for the year as a whole against the higher-yielding non-QE currencies. Where we've seen most of the yen strength, though, has been against the dollar. And, you know, from a fundamental perspective, the dollar looks no better than the yen. Longer term, we see the possibility of some dislocations in the yen, you know, further out based on the scenario that's building in Japan. That's our baseline view.
Yeah, I mean, I had a guest on Friday suggesting that we could see it up to 110 against the dollar sometime in the middle of next year. Do you think that's possible? I suppose anything is possible.
Yeah, anything's possible. We have, towards the end of 2010, middle of 2011, we have levels close to the 95-100 level. At some point, the yen is likely to take back some of its gains versus the dollar because, like I say, the yen doesn't look good from a fundamental perspective. But it always is going to be, you know, the question is always going to be from what level does the yen take back those gains? It could actually get as low as 80 in the next 6 to 12 months. Absolutely, it's not out of the realms of possibility.
Right, the storm's not over for the pound. Where do we go next?
Okay, yeah, that's what we wrote on our December outlook. You know, there are a lot of downside risks for the pound in 2010, but there are also some upside risks. For example, you know, we could get a snap election early in 2010 and a very sort of austere post-election budget, and that could actually help the pound in 2010. But our baseline scenario for the pound is that we will not see these drastic cuts that are needed to shore up the fiscal situation in the UK over the medium term, and hence we expect further declines in the pound versus the dollar, and also, more importantly, versus the euro by the end of 2010.
What about sovereign debt risk? Is that what we're referring to here as well? And that's going to be key, isn't it?
The outlook is awful. I mean, everyone's looking at Greece right now and saying, oh, Greece is in the worst scenario. I mean, although the situation is very bad, which is plaguing Greece right now, you know, what we're hearing from the Greek officials about taking the drastic measures today that they avoided taking over the last few decades, this is precisely what we need to be hearing from the countries that still have the AAA rating, but we're not hearing it. And that's why I think, you know, sovereign debt risk is only going to build in 2010. You're probably going to see a steepening of the yield curve on the back of sovereign debt risk, and the outlook is not particularly good. Another reason to hate the dollar and sterling over the longer term, sovereign debt risk, absolutely.
Stephen, we've got about 20 seconds left. What about your trade of the day?
Well, as long as the risk mentality, the risk-off mentality continues with us as we head towards the week, barring anything unexpected, anything that is long, any positions long, long yen, long euro, long sterling versus the Australian dollar, long dollar versus the Australian dollar, we're keeping a close eye on that. We expected some shakeout of Aussie long positions between the beginning of December and the end of January 2010. So we are seeing that at the moment.
Stephen, have a good one. Have a great Christmas.
Thanks very much. You too.
Stephen Gallo there joining us from Schneider Foreign Exchange.